Hi and welcome to the first episode of our podcast series, Know Your Mutual Funds by Multipl. I'm Nikhil Joseph. I'm the investment analyst at Multipl. Joining us today is Ms. Shaily Gang, Head of Products at Tata AMC. She's been associated with Tata for close to 5 years now. Shaily brings with her a rich experience of 19 years in the investment and product domain. Thanks a lot for joining us today, Shaily.
My pleasure.
Before we begin, just a quick disclaimer: this video is for educational purpose only. No portion of this should be construed as an investment advice. For specific, personalized, detailed investment advice, please consult a SEBI registered investment advisor. Uh, Multiple Wealth is a SEBI registered investment advisor. We are the world's first and only spend vesting platform. It enables you to invest for your goals in recommended mutual funds based on your risk profile, time horizon, goal value, and market valuations for both long and short term goals. Moreover, Multipl also provides exclusive benefits from 200 plus brand partners for your planned spends. I'll give you a quick introduction of this podcast since it's our very first one. It's called Know Your Mutual Fund. So, with dedicated effort from the whole mutual fund industry, आज सबको पता है कि म्यूचुअल फंड सही है. But after talking to a lot of retail investors, we realized that there is still a gap in understanding the various types and categories of mutual funds. And many times they have a difficulty in selecting the best mutual fund that is suited for their own needs. With this podcast, what we are trying to do is get more information about, help you understand about the mutual funds that you're investing in, and get more information about what the fund managers or fund houses are thinking. Most of the data that is available today is historical and gives a rear view mirror picture of the securities that we are trying to invest in. Now, the outperformance of any mutual fund or stock at any given point is actually the outcome of decisions taken by the fund manager in the past and may not be the best representative of the expected future performance. This is why often funds that are performing very good in a certain year may not continue the same performance in the subsequent years. Now, the future expected return is actually dependent on how the portfolio is positioned today. So, with this podcast, we aim to fill this information gap and bring to you and help you understand the mutual funds better. Mutual funds, matlab risk. When we talk about mutual funds, usually what comes to their people's mind is equity as an asset class, or that there is a lot of volatility linked to the market, right? But there are other categories also present in the mutual funds, right? Shaily, if you could just walk us through a little bit more about what all categories and subcategories are there in mutual funds and how the people can select what is best suited for them.
Thanks, Nikhil. Thanks for this podcast, and very happy to be here talking about mutual fund as a category and the risk return discussions. What we see is what all mutual funds can cover in terms of geographies, in terms of the asset classes, and in terms of the sectors. If as you see, there are various geographies that mutual funds now can invest into. 0 to 35%, so that the equity taxation of the fund is intact, and that is why I mentioned 0 to 35%. Of course, there are 100% overseas funds also, and those can capture the themes there or the broader markets there, and you could invest into overseas funds through Indian mutual funds, either through a fund of fund route or ETF route, or a fund of fund where the underlying are overseas ETFs, and even the active diversified equity funds, equity mutual funds can take exposure between 0 to 35% to overseas assets, overseas stocks, if required, if need be, that can be done. The asset classes which get covered by mutual funds, you know, uh, are equity, debt, and of course, when you bring equity and debt asset class together, there are hybrid funds as well. The sub asset classes of large cap equity, mid cap equity, small cap equity, international equity, that gets covered. On the fixed income side, you have corporate bonds, CDs, CPs, government securities, treasury bills, credit risk, or double A plus and double A and lower instruments can also be covered if the fund wants to. And of course, gold ETFs are there to capture the gold asset class. And currently, on the mutual fund side, you have REITs, which is real estate units and real estate debentures, which equity funds and debt funds can buy respectively. So that's the wide array of asset classes that mutual fund can cover. The platform called mutual fund can cover. Well, when you zoom into equities, let's say the various sectors, and these are just sectors. Within these sectors, you have basic industries and you have subsectors as well. So which can be covered. Like under pharma, you will have domestic pharma, US pharma, hospitals, diagnostics. When you talk about financial services, you will have banks, PSU banks, private banks. You will have asset management companies. You will have MFIs, and likewise for each sector, you can actually deep down. Consumption and banking, consumption and financial services are two very big sectors, which are there. And under consumption, if you were to talk about the subsectors, you have consumer durables, consumer services, FMCG, and the likes.
Right.
Infrastructure again is a very wide segment. So when you talk about mutual fund, it is the various categories cover a lot. This is the canvas that we can say. Importantly, it's important to note that the winner keeps changing each year. And as you can see here, in 2013, on the geography side, Japan was at the top. On the asset class side, international equities did well. And on the sector side, IT was the winner. Let's say come 2017 as a geography, Hong Kong was the best. Small cap was the winner in the asset class, small cap equity, and consumption sector was the winner. 2019, again, the sector winner was financial services. So the winner keeps changing, like you see. And mutual fund as an asset class, mutual fund as an instrument, sorry, navigates through these geographies, asset classes, sectors to construct its portfolio.
Right.
Again, to answer to your point, Nikhil, that what are the various categories which are there. Uh, the regulator has done a great job in categorizing so that each asset class can have various categories of funds, which are kind of homogeneous to each other, but within them also the way the portfolio construction can happen, you could have differentiation in the funds. So likewise, under equity, you have large cap funds, large and mid cap funds, mid cap funds, small cap funds, multi cap. Then you have on the value inclination side, you have dividend yield and a value fund. On a concentrated portfolio, PMS, like you can say, you have a focused fund because there the cap on the number of stocks is 30. And then if you zoom in on a particular pocket on the market, you will have sectoral and thematic funds. So sector funds would cover one sector, whereas thematic funds would be could have a combination of multiple sectors, 2 to 3 sectors, and it would cover a little larger part of the market as compared to sectoral, but of course a smaller part of the market as compared to the wide indices like Nifty 50 or Nifty 200 or Nifty 500. And then you have ELSS, which is a equity linked savings scheme. So that's another category. It has a lock in there. Now, these are all active funds that we are talking about, wherein the fund manager would do its fundamental analysis of the stocks, and at that point in time, wherever he thinks he needs to take overweight position, he would do. Of course, at the background, keep the benchmark in mind and as a reference. But yes, bottom up approach in these active funds means that you would go overweight on certain of the stocks where your conviction is very very high. So that's
Right.
how you explain an active fund. On the fixed income side, the debt side, you have multiple categories. Primarily the categories are to cover the spectrum of duration, which is 0 to 1 years, then 1 to 3 years, 3 to 7, more than 7. And there are duration limits attached to each of the to most of the categories. There are few categories which are defined by instruments. For example, banking and PSU fund, PSU debt fund would mean 80% needs to be in AAA banking and PSU securities, or corporate bond fund would mean that 80% needs to be in corporate bonds. And so likewise, there are few categories where which are defined by instrument, but you have many categories who are defined by duration. Then you have liquid funds and overnight funds, which are catering to emergency needs. So those are very stable, accrual oriented, those kind of funds. You have hybrid funds for hybrid or moderate risk profile clients, wherein you have as various asset classes, primarily equity, fixed income covered into that. So you can actually define it by equity arbitrage, fixed income. Uh, some bit can also, in some cases, the commodity arbitrage and commodity directional is also activated or enabled in the funds. So it is a complete gamut of asset classes there. Two types. One is a static asset allocation. Some funds could follow, some category could follow, or some could have a dynamic asset allocation depending on a model. So that's the hybrid asset class. When you bring debt equity together, and uncorrelated asset classes together, you actually bring down the portfolio risk. And obviously, a fixed income asset class, has lower standard deviation than an equity, and it controls the overall risk quotient over a period of time, which caters very well to the hybrid profile of a client.
Right.
And then you have solution oriented funds, which are equity funds largely, retirement fund, children fund, and then you have index funds, ETFs, which are the passive funds or fund of funds. These are the categories largely for active. When you zoom in on the passive side, you have ETFs or index funds which are mirroring or based on, I wouldn't say based on, they're actually replicating the broad market indices like Nifty 50, a narrow market index, or a very broad market index like a Nifty 50, Nifty 500, sorry, and also indices covering the mid cap space and the small cap space. Then you have sectoral indices, which covers various sectors. They mirror or they replicate, the already constructed indices by index constructors like NSE and BSE. The funds only replicate their holdings. These funds actually require a lot of inputs and a lot of maintenance on the operational side to replicate. There are a lot of technical challenges or things which need to be taken care of. So it seems very uh, at the periphery, it seems that, oh, it's just a replication, but the key here is the operational efficiency. The bid-ask spread on the screen, and at the back end, the operational efficiency in terms of how much cash percentage you keep, and how often do you rebalance, how do you replicate, equate with the index, and all that stuff. So it's a different ball game altogether. Then you also have strategy indices like momentum and low volatility, quality. And these are just some examples. You have multiple combinations and a huge list. Then you have again debt passive indexes, which are only based on gilt, G-Secs, only based on PSUs, only based on AAA bonds. And again, as I mentioned at the start, there are overseas indices which are replicated, by these ETFs here. So Nasdaq 100 or China based or Europe based. So this is on the category part. Now it's very, very important. So that's the canvas that we just saw. Now
Right.
you need to take a lens, and these are the various lenses that you could take to understand the risk reward positioning of the category or of the fund.
Hmm.
And largely, uh, the green would mean that it is safer, but in some of the lens, it might not be absolutely true or clear cut. So I'll come to
Right.
that. So, for
Hmm.
example, a diversified equity, will be relatively high risk than a hybrid equity, which has a debt component also, and as compared to a pure fixed income portfolio. So that's the asset class lens that we are taking. If we were to take the type of the fund lens, which is active or passive. Because active requires you to take judgment calls and go overweight on certain stocks, it could actually give you a higher alpha. But at some point
Right.
in time, it could also, at some point in time, you could look worse than the index also. But
Right.
overall, the idea of active funds is over a period, the stock returns track the earnings of the stocks primarily. In the interim, there could be some mispricing which could happen, but over the long run, the stock prices reflect the earnings potential and the earnings, rate of the earnings growth rate of the company, and that is why, the risk gets smoothened out over the long term. However, in the interim, you could have these funds because they are taking overweight and they are taking categorical sides and taking overweight on certain stocks, so that the risk could be that much there. On the passive side, what happens is you are replicating the index, and you're
Mhm.
just, if you're doing a broad market, you are getting the broad market returns. If you are diving deep, and building a passive fund on a sectoral index, that obviously, you might outperform the idea is to outperform the broad market. However, if you compare the index and the fund, it would be similar returns, because with some tracking error, because finally the fund is replicating the index. So here in this space, it is important to know what is area of market is being taken, and on that the passive fund is being built. That's the key here, because it depends on what are you comparing that passive fund with. Are you
Right.
comparing it with the broad market? Are you comparing it with its own index? Are you comparing it with an active fund? So that's the discussion here. And then, as I said, market coverage, because a thematic will zoom in and a fund will zoom in into pocket of the market. Obviously, the risk is higher there as compared to a diversified. The next lens is market cap. As you move lower the chain of the market capitalization, the riskier, or the higher relatively, riskier it becomes. So large caps are relatively lower risk than mid caps and small caps, and vice versa. Then you need to take the philosophy lens. There are some funds and fund houses which only are growth oriented, and there are some who are deep value oriented, and some like us are growth at reasonable price. They're somewhere in the middle, and they can keep changing the tilt depending on what phase of the market we are going through. For example, if the interest rates are in a hike phase, then obviously the value tilt starts showing up, and the value stocks start keeping well, because your discipline to the valuation kicks in. When and then when you have lower interest rates, and probably, likewise, when we had a pause in the interest rates, the growth stocks, again picked up. On the style side, the more you have earning stability, the safer the portfolio is. And the more stocks you have on earnings surprise and earnings turnaround, of course, it is expected to have higher alpha, than a higher alpha over the benchmark returns. But obviously, the high risk, high reward equation kicks in there. Uh, Focused fund, as I mentioned, is highly concentrated, so obviously, and there, the concentration risk is higher, and funds which hold 60s 55 60 stocks, they are more evenly spread out in terms of holdings percentage, each stock exposure percentage, and the concentration risk is relatively lower than, let's say, a focused fund category. A top down and a bottom up approach, again here you cannot take sides. Bottom up is related to your active bets, and again you are going ahead and taking overweights on certain high conviction stocks, and might not be hugging the benchmark so much. So that's the bottom up approach. At some points you could create a great alpha over the benchmark, but at some points in time you could be looking lower than the benchmark as well. But the idea is, again, over long periods, long period returns to outperform the benchmark. That's the idea, and that's why the bottom up approach. Top down is an approach which we follow in only one category, which is business cycle, where the thesis is that if we want to align ourselves to the events that are happening back to back in
Right.
fast cycles, and the cycles are changing much faster, how can you best position yourself? Then you take a top down approach, and which is what a business cycle funds does. And last lens could be the benchmark coverage, which is if you are more inclined to the benchmark, which you means you have high active no, sorry low active weights, which means if you are higher if you have high coverage with the benchmark, you have lower active weights, uh, then you are relatively less riskier as compared to funds which have very high active weights and are very, very different from the benchmark. For example, I'll give you one example. In infrastructure index, I think NSE and BSE, capital goods exposure is zero. And capital goods is one segment which we are very, very, bullish on. Of course, now it has a run up, and we continue to take exposure to those capital goods and industrial segment. But when you are managing an infrastructure fund and when you are constructive on capital goods, you will definitely seem too away from the benchmark, because you are 38-39% into 40% into cap goods, and whereas the benchmark does not have any.
Right.
So active funds will tend to take those that calls. Now, with
Right.
that risk return lens in mind, you have this the positioning of equity fund categories like this. At the start, you have index funds, which are just replicating the broader markets. Here, I'm talking about more so
Yeah.
Nifty 50. Then you are Nifty Next 50. Then you have large cap funds, which are market cap at the high end of the market cap chain. Then when you introduce some mid cap to it, minimum 35% mid cap in the large and mid cap category, that's why it's higher on the risk return chart. Multi-cap needs to have by mandate minimum 25% each in mid and small. That's why it is placed higher than large and mid cap, because theoretically large cap could have 65% large and mid cap fund can have it can have 65% large caps as well. But by mandate, a multi-cap fund can needs to have minimum 50% in mid and small cap put together. So that's why it
Right.
comes ahead. Dividend yield is actually a value tilted fund, and that is why it's picking one part of the market, and that's why it is kind of in between there. ELSS is a locked in category, and a multi cap, again, you could go either ways, whichever. There's no cap on the market cap that you need to take. Again, value fund is, which is a equity PE fund in our parlance, is again one part of the market. Focused fund is higher on the risk return because of the concentration risk. Mid and
Right.
small cap is higher because of the going down the value market cap value chain, and then thematic and sectoral.
Right.
Similarly, very interestingly, hybrid funds also have a stack, and I did explain to you the static and the dynamic asset allocation. I think this slide will explain it better, because hybrid equity is, let's say, largely hybrid equity would be a static allocation of 70 is to 30, or 75 is to 25, and
Mhm.
that's why you see, for illustratively, 77% as net equity. You come to multi asset, you could have 65% minimum you need to have for equity taxation, but yeah, you could go down a little bit and fill the bucket by that 65% bucket, the balance by equity arbitrage. The equity taxation would remain. You
Right.
go down BAF, balance advantage category, you could be between 42. So like we are in the mid pack of the net equity exposure in the BAF category. So that's why you see 53% here. In fact, we would be around, I think, 48 to 50% on an average. This is as on a particular month end, so it's showing 53. But on an average, this would be 50. So again, lower net equity, and equity savings is the lowest net equity at 30%. So you have a hybrid stack also with varied amounts of net equity exposure, which defines
Right.
risk in the category.
Right. So this
Yes.
really helps, put in perspective, especially for the various asset classes, which, like you said, mutual funds are actually an instrument which help you invest into various asset classes, and you've very well put the various categories also of different kinds of funds in equity and hybrid asset classes, particularly. Now, when it comes to debt funds, right? Can I ask you that are they suitable today for the retail investors? There are a lot of there is a lot of institutional participation in the debt funds, but not so much in retail. And especially given that today interest rates are on a higher side, what is your view on debt funds, and whom will they be more suitable for? maybe from a duration perspective or an investor category perspective?
So again, there, Nikhil, I would say that people should look at categories and first, of course, is the asset allocation. Once you have decided your broader asset allocation within the fixed income, horizon plays a very, very important role, and you have to map that horizon with the kind of volatility that you could take. There are clients that within the horizon of 1 year also, they would prefer to have very low minimal volatility, and let's say take a money market fund as compared to let's say take a treasury advantage fund, which could actually go and capture a little bit of higher duration buckets also. So it's important, the broader asset allocation, then your horizon, and then the volatility that you can take, because all these funds are actually a combination of accrual and some alpha creation on account of trading, securities trading, or depending on the interest rate scenario. Largely they are accrual oriented, but there are some funds who could go up 10 to 20% tactical and do some alpha creation and some security trading there, like you can see in this chart. So that obviously adds to the little bit of volatility, and that the investors can decide. For example, 0 to 6 months, liquid and overnight actually are funds which can be just thought about for emergency funds parking. They're available to you the same day or the next day when you redeem. So that's why they cater to the emergency funds needs very well. Again, money market funds only captures CDs and CPs, which is a certificate of deposits and commercial papers. Inherently, these instruments are less volatile than bonds, and that
Right.
is why then you could look at them with a horizon of, let's say, beyond 1 month,
Right.
starting ideally 2 months and beyond. You can look at them, and they all have duration also defined, what they can do. Like money market can take securities up to 1 year.
Mm.
Treasury advantage, on the other side, which is low duration funds, can uh, need to necessarily keep their duration between 6 to 12 months. They can have CDCPs as well as bonds, so they could have a little more volatility than money market. Then you have ultra short category. Some of the ultra short term funds could also take AA plus and double instruments. So if there are clients and investors who do not want um, credit risk at all, they
Right.
credit, what happens is when you take AA and double A plus, when you go down the credit value chain, you
Mm.
again, like in equity, when you go down the market cap value chain, you get higher returns. In
Right.
debt, in fixed income, when you go down the credit value chain, you get higher yields, YTMs, and some funds could have those. So everything, all kinds of funds are available within the category. You will have pure AAA funds also. You will have funds with 10, 20, 25% non-AAA exposure also. There, obviously, the YTMs would be higher. So one needs to take the credit risk also into account. If they do not want anything, then they could just go for pure AAA funds. Then
Right.
between 2 to 3 years, you have short-term funds. So between 1 to 3 year horizon, you could take a short-term and BPSU debt fund. These funds would have 10 to 20% tactical, uh, uh, what you call
Allocation
type of
schedules. Yeah.
management. Yes. So
Right.
accrual is one strategy, but you could also have some, for alpha creation, some trading of securities that could happen. Again,
Right.
corporate bonds, you could have both kinds of corporate bonds. Like our corporate bond is the only corporate bond which has taken 25 to 30% non-AAA
Mhm.
exposure, whereas all others, so we are unique from that perspective, but all others are pure AAA.
Right.
Likewise, in short term, we are one of the few funds who are a pure AAA, because that's how the fund is constructed, and that space. And few of our institutional investors would want us to drive that. But there are
Right.
other short term funds which have non AAA exposures. So what you
Right.
need to see is asset allocation, broader asset allocation, your horizon, volatility, and volatility is mapped to duration. But the
Right.
other risk is the credit risk, which is also what you need to see. Uh, when you are picking a fund. Largely, if you were to see with 3 to 6 months, you could look at under 3 months or under you could have liquid and liquid and overnight funds. On a very conservative side, I have moved the investment horizon to 3 to 6 months for ultra short money market and low duration funds. You could have, if everybody has slid down the duration, then you could also take exposure to these funds very at the very short end with a 2 month horizon also. But
Right.
yeah, largely to be very conservative, 3 to 6 months, 6 to 12 months floating rate funds, because they keep adjusting their net duration by using using floating rate funds and using a synthetic book or OIS positions as we call it. And then between 1 to 2 years, you could have short-term bond funds, corporate bond funds, and banking and PSU debt funds. And above 3 to 5 years, you could have government securities fund. Now, government securities are very, very liquid, and that is why, depending on the interest rate view, expected inflation and expected interest rate cycle and current cycle where we are in, what we think, you could slide up and slide down the duration very easily, because these instruments are liquid. You cannot do that slide up and slide down in a corporate bond fund. You cannot sell a 10-year corporate and buy 5 year, and as easily sell 5 year and go into a 7 year corporate bond. You cannot do that. But in
Right.
a gilt fund, you can do that very swiftly, and that is why it tends to have higher volatility, higher changes, higher movement. So that's the canvas of the fixed income space.
Right. Right now, this is really helpful actually. So, like I had mentioned, Multipl is also a spend investing platform, and a lot of times people struggle with the allocation for short duration goals. Because long duration, it might be more intuitive that okay, if I invest in equity, there'll be some volatility, and my job is to maybe hold on to it, and probably I'll generate a certain amount of return. But when we come to the short term, quite often we go for a very safe option, which might be like a bank FD or or an RD, which does have its own merits. But then probably something like a debt fund, which is out there in the market, which has some benefit of liquidity over other instruments, can be beneficial to the client, right? So
One more point,
this is
Nikhil, I
really
would want to add to you to what you're saying. The benefit is that the tax implication comes in case of
right.
a debt fund only when you redeem the
Only on
folio.
redemption. Correct. So that is
Otherwise,
one aspect which is quite often overlooked, right? Especially with the recent regulation of taxing the debt funds at the same at the marginal tax rate. It may seem that FD and debt has become equal taxed, but it's actually not so, right? If I defer the redemption for 5 years, that
true,
effectively makes my total tax payable only once, right? It helps me compound my gain. So
absolutely.
this is really helpful. Yeah. So now the next question comes. Now that I'm aware of various asset classes and categories, how long should a investor typically invest for? What is the duration? And behaviorally, how does an investor think about their spending their time in the market or being invested in the market?
Yes. Yeah, yeah, very interesting area to talk about. Just setting some context to that, Nikhil. Yes, time in the market, how does that help? What if you are not present, what do you miss? Yes, we will discuss few of those things. And how does risk get smoothened in the long run for equity as an asset class? That is a very interesting area again to talk about. Before that, just setting the context for these four asset classes: equity, fixed income, real estate, and gold, for period wise returns. When you look at a 10-year return, it is, of course, equity. The return bar is the tallest, followed by fixed income, and then real estate and gold. Real estate is very, very illiquid. Yes, there are people who are lot interested into the perpetual rental income coming from that, but to get that, there is a lot of hassle which one needs to do geographically also, and maintaining physical real estate assets and monitoring them is definitely not very easy. We've seen families where as they have gone into higher age brackets, they are not able to keep up with the energy to manage the uh, you know um, uh, the properties overall wherever they have kids have traveled to offshore overseas, and they're studying or they're settled overseas. So that's another thing. So of course, real estate, I wanted to mention that of course returns are all for all to see here.
Yeah.
But yeah, there could be phases where gold, the risk of phase is there, and probably in that phase gold looks better. On gold, we maintain that 10 to 15% perennial presence of gold in the fund or commodity rather in the overall portfolio helps, because it's less correlated with other asset classes and it brings down the portfolio risk. So that's something which I would like to mention. This is a very, very important chart. One reason why we all should invest is, of course, because there's no 100% probability of anything. Because the best you can do is, of course, you cannot make a list of all those risks that can be. COVID was one such example. Nobody could have thought about pandemic, but the best way to prepare ourselves is prepare ourselves financially, and that's one reason why we should invest. The other important reason why we should invest is inflation, to beat inflation, because that's one animal. As you can see, the growth rate of the typical consumer basket, which is represented by the first row, is close to 10%.
Right.
Many of your other traditional instruments might not be able to do that. In fact, I was reading today some post, I think from a handle, which said that even the worst of the mutual funds, and this is with due respect to each instrument, but it was mentioned that even the worst of the mutual funds were outperforming the traditional small savings rates and all. Of course, they have
Right.
lock-ins as well. So from that perspective, they cannot keep up with the consumption, the inflation on the consumption, actual consumption basket of the customers. The CPI basket of, obviously, their that growth rate is also 6 to 7%. Gold is at 9%. Sensex, which is representing equity as an asset class, is close to 15%. In spite of the lot of ups and downs that we all know of, the events caused by the events, various events, globally and domestically. So that's why we say that equity asset class is best suited, or is best expected to beat, inflation, because as we can see, the CAGR of Sensex, which represents equity, is at close to 15%. Uh, Now, benefits of long-term investing and how the risk gets cut down when you stay invested for longer, because the instances of negative returns go down as you increase your horizon. So what you see here is the rolling returns: 1 year,
Right.
3 year, 5 year, 7 years, and 10 years. And at the top, what you see is the historical instances of positive returns and historical instances of negative return, and the
Mhm.
max, min, and average are returns are represented there. So the maximum return in the 1 year is 100%, but on the minimum side you could have a 50-55% drawdown as well. And the
Right.
average return on a 1 year basis is the it is about 17%. And these returns, the period for which these returns have been taken is since 2000.
Mhm.
Then when you come to 3 year rolling returns, you have 51% as the maximum. You do have 5.2% negative return, and there have been 2% of the instances which are negative when you do a 3 year rolling. So from 1 year to 3 year itself, you see a 17% negative instant percentage, 17% instances of negative returns that has dropped to 2%. When you do that rolling return analysis on a 5 year basis for Nifty 50, that has dropped to 0.1% of the overall observations are instances of negative return. And
Mhm.
when you move to 7 years and 10 years, there are zero historical instances of negative return. And equity as an asset class is supposed to be invested into for long periods, and this very well brings out the same, that if you stay invested for 7 years and 10 years, the probability of you getting a negative return is very, very low. And the volatility also smoothens out quite a lot in the longer term.
Right.
Uh, One very important point is, and this is related to timing the market, so one very important point from that perspective is we need to be present. An investor needs to be present in the market. And otherwise you would tend to miss out the best day returns, and none of us would know when the best day return would occur. But if one needs to capture those in the portfolio, one needs to be present every time, so that during that longer period presence, the best day returns can be captured. And that would, as you can see in the chart, if you were to account and include the best day returns in each year since 2000 into the returns, your nifty return or nifty levels would be much higher than the black line, which represents the value if you had missed the best day returns each year. And
Right.
it's not humanly and practically possible that you time it in such a manner that you come in at the bottom and you always capture the best day return. In fact, it's okay to enter the market at any point in time and not think too much about it. Of course, your rebalancing will take care of you booking out of the asset class which has swelled too much into your portfolio, and all that the advisor can do very well. And this again represents that the fact that the more time you spend in the market, your corpus will more be a function of the compounded returns than the capital you invested. If you were to enter, let's say, even at peaks of Jan 2000 and March 2015 and 2020, but if you were to spend a good amount of time in the market wide SIP, your current portfolio amount would be close to 50 lakhs, whereas your invested amount is about 18 lakhs odd, and you would have by now taken exposure to all the levels of the market through 188 installments. If
Right.
you if you would have invested only since later, since March 2015, see the dark blue color, the pie obviously of the compounded returns is shrunk, or is smaller,
Right.
and your capital amount obviously is a larger pie, larger space in the overall pie. And the later you start, let's say very recently in 2020, you would have invested about 2 lakh 30 by 23 installments. However, your portfolio amount only would be 2.5 lakhs today. So this is a very good example that one is we need to be always present to capture the best day returns. And the more time we spend in the market, the more, better the portfolio compounds. And irrespective, markets are not linear in the short term.
Right.
Directionally, they are up in the long term, but in the short term, they are not linear. You will have events, you will have reactions to those events by the market. And in the last 40 years, when we talk about Sensex as an index which represents equity, every year has seen close to 5 to 10% drawdown. However, intra-year drawdown I'm talking about, there would have been one day where the drawdown would have been about 5 to 10% as compared to what the level was at the start of the year. However, the compounded annual growth rate for the last 40 years is about 15%.
Right.
And that's something which is very, very important to note. Even if this number was 20 years, the CAGR is a double digit, would be a double digit number. So
Right.
that's the important thing to note here. And for long periods, a compounded annual growth rate, a double digit compounded annual growth rate is huge. When your wealth compounds towards the end, when the base is bigger, 15% compounding on that is
Right.
huge.
It's almost 50% higher than the household average inflation that you had
Yes,
shown, right? And
yes,
more than 2x of the CPI.
yes, yes, yes. So that's important. And there is portion we definitely saw how the instances of negative instances smoothen out when we take a rolling return for a 7 year period.
Hmm.
And if you continue to invest, the benefits of that are humongous. Again, this slide again represents that. If you were to do a SIP of 10,000 rupees in Nifty 50 index since 2000, August 2000 is the data showing here. And this is, we are talking till August 23. So this is a 23-year data that we are talking about. Had you continued to do that SIP, your 10,000 rupee per month, the value of that would be 1.61 crores. If you stopped the SIP but did not redeem the investments that occurred between 2000 to 2009, and continued those investments, that kitty, that corpus continued, the current value of that corpus would be 1.23 crores. And if you redeemed the monies there only because of the global financial crisis, and you were shaken with that and you redeemed the portfolio, the value then, what you redeemed, would have been 33 lakhs.
Right.
So the benefit is from 33 lakhs to 1.61 crores over a period. And yeah, as you rightly
Right.
reiterated, Nikhil, the growth rate is important over a long period of time to take care of your inflation,
Right.
inflation animal. The other part, which is what we want to highlight, is that portfolios are made of various asset classes: equity, debt, commodity, equity arbitrage, commodity arbitrage, gold, directional gold, and all those asset classes in various portfolio mixes. We have taken some illustrative portfolio mixes here. Like the first portfolio that you see is 50-50 equity debt. Then what you see is 65-35 equity debt. Then we have added 25% commodity to that. Then we have next we've added equity arbitrage and commodity arbitrage to that. Then we have taken a portfolio only of commodity arbitrage, commodity and debt, and just 10% equity, and then we've removed the equity completely. So if you see this stack, you see that of course the returns get adjusted according to the asset class, because finally the portfolio returns would be a weighted average of the asset classes exposure that has been taken to in the portfolio. But as you see, the risk also comes down when directional commodity is added to the combination of equity and debt portfolio. The risk remains the same, but return profile actually improves. In other cases, when commodity arbitrage and directional is added to equity arbitrage and debt, the portfolio risk comes down tremendously. And as
Right.
you can see that, yeah, from they are added to equity arb and debt. So equity arb and debt, if you see, the portfolio risk has come down from 0.76 to 61. And then the portfolio of commodity arb, directional commodity and debt is constructed, it actually comes down to 0.22, with your return being at still more than 8%,
Correct.
8.1%.
Yeah, risk has almost dropped one third, whereas
Yes,
returns are only maybe 20% lower, less than that.
yes, yes.
So no, this is very insightful actually, because a lot of retail investors, when they think about investing, intuitively the first thing that comes to mind is the return, and maybe by default you may be choosing say equity, or maybe even small cap alone or something like that. But the risk adjusted return is something which really puts things into perspective. So if I can ask you that, how do you think an investor should invest, and particularly if they can link it to their own goals? So while you have shown how various asset classes can add some a bit of let's say diversification and lesser volatility to the portfolio, but when does this link to their goals, and how can they monitor and rebalance with or without professional help? But what is the importance of actually monitoring these assets given the different volatilities that you've highlighted?
Yes, yes. So one is, Nikhil, it's difficult for normal investor who's not into this space to continuously monitor and screen and map various asset classes performance, micro macro factors and sector performances. As you can see in this heat map, which is the asset class or heat map or sub asset class heat map, which covers again the same asset classes which we spoke about at the beginning, but this is with data for for each calendar year since 2013. And as you see again here, the winner is different. In 22 you had gold as the winner, in 18 again you had gold as the winner, but in 21 and 20 you had small cap equity as the winner, with high double digit returns. Again, 2017, you had 60% returns. Then you have 2015, where the second in line is corporate bond. Again, 2018, where the second in line is GSEC at 8%. So very, very difficult to, and winner keeps changing and difficult for anyone to keep track of that.
Right.
Similarly, you see sectors, again, the heat map here presented for sectors and winners is different. Banks leading the chart in 2014 and 22. Uh, IT leading it in 21 and 2018. Consumption being at the top with a whopping 46% in 2017. And one important thing which we just, some number crunching that we did was, if you were to look back and, choose to invest in the top two sectors in the previous calendar year, let's say, this is a
Right.
calendar year data and the data crunching was done on this, you probably would, you were to do this exercise and each year and continue till 22, the return was, the results were at about 8%. If you were to just change that allocation and say that in all sectors, I would do an equivate, the return jumped to about 13-14%.
Right.
And the way to think about this is, then if you were to do a proper research and go with a advisor accordingly, or a professional platform, and take exposure to mutual funds which are managed by, again, MF, professional fund managers. And if the same, because the categories are so many, there are too many things, and if they are being advised by the advisors on those categories and those allocations, this return would definitely, go up, or at least is expected. The probability of that return to go up would be higher. Just by looking at the rear view mirror on the sectors, if you were to just invest in the top two sectors, it was about only 8% return.
Right.
So, professional guidance does help, because the canvas is very large, I would say. This is just a very illustrative chart to say that how can one start, or how can one look at investing, keeping time to goal in mind, objective, and dividing the portfolio into liquid and core and tactical portfolio, and how can you fit in categories, keeping the objective and the time to goal in mind.
Right.
So which is where, I'm sure, this is just an illustrative one, but you and your platform would do that in multiple combinations for your clients and investors, and that would really help. And you also have to look at various mutual funds, and not just single fund house. So mutual funds are also, multiple the fund houses. So all that can be fit into illustrative, portfolios like these, depending on the client's risk profile and the time horizon and the volatility, capacity to take on volatility.
Right.
So I'm sure this will help.
So, if I can ask you here that can we talked about the importance of rebalancing, because like we saw the various sectors do well in various periods, and various asset classes also do well in different periods. So, can we see some bit of this in action, maybe in any fund that at Tata Mutual Fund, any fund that where you are doing this active rebalancing, and that is generating probably a better return
So
for or risk adjusted return for your investors.
yes, the way, Tata also has this presence in the category balanced advantage fund. We have this Tata BAF fund, and we've been following a model, in a very disciplined manner. So the model is followed in a disciplined manner. Within the model, whatever, under that model, whatever allocations on equity and debt side come in, under those asset classes of equity and debt, the stock picks are taken by the fund managers after a lot of research. So that is done. And as you can see here, what is charted out here are the Nifty 50 movement, and the equity allocations each month of Tata BAF. And the strength of the model is such that we are not too fast in raising equity percentage when the market's correct, and when we are not too slow in cutting down the equity portion when the markets rise. And there are two parts to this model. One is, of course, the valuation part, where we have a valuation band, and keeping that valuation band in mind, we have an equity exposure, and that equity exposure can be adjusted plus minus 10%. With the second part of the model, which takes into account the macro factors and the correlation and volatility, implied volatility correlation, and some of those macro indicators. But there are points in time when the macro indicators or macro factors are, the signals are not very clear or they are weak. Then we just go by the first part of the model. If the signals are very strong on the positive side, we add 10% to equity allocation. If the signals are very strong on the negative side, and then we cut down 8 to 10% of the equity allocation. And by doing that over a period, what we have been able to do is have a good upside capture ratio. When the Nifty is positive, we are able to capture 60% of that positive returns. But when the
Mhm.
Nifty corrects, we actually fall only 20 to 30% of that Nifty negative returns. So by doing that on a very consistent basis, and you can see the data for FY 20, 21, 22, 23, and now since inception, also, if you were to see that, we have been consistently doing that, and because of doing that, we've been able to generate better risk adjusted returns
Right.
for our investors. If you were to just have, for reference sake, you can see the volatility of the fund is only 10%, close to 9.5, close to 10%. However, the Nifty volatility is about 19%. Nifty has been 21 times, has seen 21 negative months in that period, which is since inception, which is since Jan 19, 2019 till July 23. This data is till July 23.
Mhm.
Whereas the fund has seen only 15 negative returns. And also, it's important to notice that the extent of negativity, which has been average 3.5% negative, for our fund, it's only about 1% or a little over 1%.
Right.
And all this translates to a better risk adjusted return, which is 0.84 for Nifty, but for Tata BAF, it is 1.46. So return per unit of risk becomes much higher. And that's the smooth journey and smooth
Right.
journey which we would want to give to our
That's a
client.
pretty significant difference, actually. Right.
Yes, yes. So, yeah, that's in a nutshell Tata BAF.
Right. No, thanks. So this actually, shows how rebalancing or valuation conscious asset, rebalancing and investing
And
can help you
and all
generate
that
a
is
higher.
done under the fund. So because
Correct.
when we do these changes, there
Right.
are no other tax impact
Right.
happening.
Correct.
So we are
Correct.
doing it within the fund. So that's very
Correct.
important to highlight.
Right.
Yes.
Right. No, this actually puts a lot of things into perspective, and how actions can actually help you generate a much higher risk-adjusted return compared to maybe facing a higher volatility. Now, finally, I would just want to ask you. So, most of what we have discussed and seen has set a context of which asset classes and how to look at them and how to invest. But truly, the essence of what we are trying to bring out is how can we position our portfolios better today, and what is the view that Tata Mutual Fund has, and maybe how have you positioned some funds according to your views. So given that the macro view as well as any sectoral view that you can highlight.
Yes. So, in the next 3 to 4 slides, Nikhil, I would want to cover, our house view. So, when we look at, how are we positioned in terms of earnings, growth and valuation, or earnings impact and valuation from what is happening, globally also, though we are quite delinked, we are a high growth country amongst, all the other growth numbers that have come out in the emerging markets as well as the developed economies. India stands tall currently in terms of growth rate. However, there is some impact which could happen, if there is, let's say, a recession talk in the West, or, a slower or faster recovery in China. So from that
Right.
perspective, right now we think we are in a sweet spot where it's not a hard landing or a recession in case of US, UK, the West, and the recovery in China is also quite slow. So, from that perspective, the earnings impact or impact on earnings would be quite limited, and the valuation would sustain. And whatever premium right now we are running, of course, right, in we were running a very high premium in between to the MSCI emerging markets also, but whatever is the growth premium that would sustain currently. However, if there was a case where there was a deep recession in the US, and the recovery in China also would be sharp. The complete opposite then the earnings also would have been impacted. India earnings would have been impacted, and the valuation also, the premium would reduce, and absolute valuation also would come down. So from that perspective, in this 2 by 2 chart, we feel that we are in a sweet spot currently. The long-term drivers for India, of course, is the along with the consumption, bit which is driving the GDP growth. The pickup in the investment cycle is also, adding to the GDP growth rate very well, and and there are a lot of tailwinds for Indian manufacturing sector and industrial sector, government policy changing, and added to that, the commodity prices, have come down. So all that is adding to the earnings of India. In fact, right now is a time, as we hear from our investments desk, that so many sectors together contributing to the earnings growth. That's the strength of the earnings growth right now that we see, and we are positive on sectors of banks, capital goods, manufacturing, and we are neutral in case of IT and pharma. Cap goods, of course, industrials and cap goods, we are seeing that the balance sheets, the corporate balance sheet has got deleveraged quite a bit. And interest rates are, of course, they've risen from the very lows, but they're not too high. And capacity utilization has kind of reached a number where factories can look at putting up more capacities. They can borrow because they are deleveraged right now, and interest rates levels are reasonable right now. So all that is leading to good investment cycle recovery, and that is one space we are constructing on. In case of banks, yes, there was a period where we were only looking at large cap private sector banks, but now we have also spread out to the down the value chain in terms of mid and small cap banks, MFIs. And we have gone down that, and we are looking and expecting re-rating there, and have better returns there. In case of IT, yes, there are pressures on the growth because of what's happening in the West. But we see that companies are much more glued to the digital way of doing things, and the budgets have kind of got trimmed, but not trimmed too sharply. So the IT spends rather have gone up structurally, and that is why we expect. And now the margins are also looking better. The valuations are better. They've come down to about 25-30 P, rather than at one point in time it was very high because of the during COVID, because of the demand for digital platforms and solutions. So all this makes a case for IT neutrality for us, and over the next 5 to 6 years. Pharma, we are turning slowly positive for multiple reasons, and we have increased allocations in pharma across sectors. FMCG is one area which we feel that because of rural slowdown and urban consumption, incrementally growth would be impacted. And if the input prices again go through some kind of rise, then again the margins will be impacted more. So that's our outlook on the sector. What three things, 2 to 3 things that we are doing on the portfolio side are: one, we have a very balanced portfolio strategy. We are trying to capture various pockets of strong earnings, from all the sectors. And as I mentioned, multiple sectors are contributing to the earnings growth in India. So we are trying to capitalize all of them. We increased in mid and our exposures to mid and small caps, when we participated in the run up. But now we have recently trimmed exposures a little bit as valuations ran up. However, we would not say that currently also it's not a bubble zone. bubble zone happens probably when small caps and mid caps are 50 to 60% premium to large cap valuations, but currently mid caps are at about 15-20, and small caps are at about 5 to 10%. So it's not a bubble zone, but we trimmed some bits wherever we could trim, and yet we are very much exposed to the cyclical side, or the to capitalize on the investment recovery, because many of those stocks of industrials and capital goods go and sit in mid and small caps primarily. So we continue to capture the cyclical and the investment recovery part of the economy, while even though we would have reduced or trimmed some bit of exposures to mid and small caps as a segment, because those capital goods and industrial segments sit more in the mid and small cap. So that balance we've maintained very well. And GAP, which is growth at reasonable price, is something which we continue to follow. We are very, very sensitive to the entry price or the valuation at which we take exposures to, because the fund managers are looking at making returns from here on, risk reward from a 2 to 3 year perspective.
Mhm.
Anything that you take exposure to, you should be able to make money in the 2 to 3 years time frame. For that, even if you were to look a little bit here and there on a 6 month basis, it's fine. We'll tide that. We'll tide that phase, not an issue, but very important. In fact, there have been examples how we have how we are so very sensitive towards entry price in our housing opportunities fund. We continued some hedge positions to the tune of 10 to 20% for good 6 months, because we did not find the last 20% deployment we couldn't do in building materials because the prices had run up then. Even in our multi-cap NFO post that, we had took some hedge positions till the time we could deploy it fully. And yeah, because of valuation reasons itself, we stopped flows of our small cap fund, lump sum flows. We said we would not be able to accept lump sum, because that would have taken our cash portion very high, because deployment was becoming, we were becoming more cautious while deploying. So we stopped at when we were about 5,000 crore fund. So all these things are, proof of the pudding, how valuation is very, very important for us as a fund house. Uh, just to talk about the current valuations, I already spoke about it. Currently, Nifty 50, 1 year forward P, we stand at about 19 to 20x, 19x. And this is higher than the historical average. But in October or September 21, when the market had peaked, that time, that was a kind of bubble zone when we reached 21, 22 times forward earnings, forward P, sorry. So right now we are not so much there. We are 10 to 15% lower, than that zone earlier. And when you talk about Nifty 50 valuations versus MSCI emerging markets, we had peaked at about 90, 80, 90%, 80, 85% about few months ago.
Mhm.
But we are currently at about 63%, which is a little above the 46% historical average, as you can see in the chart also. So
Right.
stable macros and broad-based earnings growth, and robust banking and corporate sector health. That is something which is keeping the premium to this extent. But that's also what is leading to the growth in
Right.
India. So I think I would stop here,
Yeah.
and maybe over to you for any
Yeah.
comments.
Sure. So I think cautious optimism is the theme, and very rightly so, given the demographic dividend that India is kind of earning. And yeah, hope to see. We'll just have to wait and see how the markets perform going forward. So yeah, thanks a lot for your detailed presentation. I think it would have given our users a very good overview of what products mutual funds have to offer, what are the different asset classes, how to navigate them, what is the importance of rebalancing and allocating assets, particularly for your own goals, and finally, how today where the market stands in terms of valuation and how we can position our portfolio accordingly. So thanks a lot for the very insightful presentation, and thanks for joining in with us.
Thank you.
Yeah, thanks to our listeners for joining in for this presentation.